There's this stock market bubble that almost nobody talks about anymore. But when it popped, it crashed the market by 50%, sent inflation through the roof, and it took eight long years to recover. And the scariest part? It looks disturbingly similar to the market we're all in today.
The legendary investor Sir John Templeton really nailed it with this one. I mean, nothing empties a brokerage account faster than blind optimism, that unshakable belief that the old rules just don't apply anymore. It's such a powerful and honestly an incredibly dangerous idea.
But that's the real question we're going to tackle here. What if the story playing out in the markets today has actually happened before? Well, to find out, we need to go back and look at a forgotten piece of financial history.
Okay, let's dive into this. We're talking about something called the Nifty 50 bubble, back in the early 1970s. Now, the name might not ring a bell, but trust me, the story will. To really get this bubble, you gotta understand the mood at the time. The late 60s were basically the peak of this 20-year economic sugar high after World War II. Factories were humming, suburbs were popping up everywhere, American confidence was just sky high. People had money to spend, tons of optimism, and this feeling that the good times were just never gonna end.
And right in the middle of all that optimism, this new investment strategy became insanely popular. It was all built around a group of companies that were so powerful, so dominant, that people started calling them one-decision stocks.
The concept was, well, it was dangerously simple. These stocks, which came to be known as the Nifty 50, were seen as absolutely bulletproof. The only decision an investor ever had to make was to buy them. The thought of ever selling them, that was considered completely foolish.
And we're not talking about some obscure companies here. These were the titans of the era. Household names like Coca-Cola, McDonald's, Xerox, and Polaroid. These were the blue-chip, cash-generating giants that everybody knew and trusted.
But here's the thing about investing. Whenever something sounds like a total no-brainer, it's often a financial grenade with the pin already pulled. And the optimism around the Nifty 50 got dangerous fast.
And this is where you can just see the sheer disconnect from reality. So while the average stock was trading at a perfectly respectable 15 times its earnings, the Nifty 50 were in a completely different universe, trading at a jaw-dropping average of 42 times earnings. That never-sell mentality had turned their valuations into a total fairy tale.
Let's just look at some examples here. McDonald's, a great company no doubt, was trading at 86 times its earnings. 86!
And Polaroid, the super innovative camera company, it was trading at an incredible 90 times its earnings. Investors weren't just paying for growth anymore, they were pricing these stocks like gravity just didn't exist on Wall Street.
This chart just perfectly illustrates how top-heavy the whole market had become. At their peak, just these 50 stocks made up about 45% of the entire US stock market. Think about that. The fate of the entire market was basically resting on the shoulders of this handful of beloved companies.
And then came 1973. The party came to a sudden, brutal end. Reality finally showed up and slapped everyone right across the face.
A whole series of macroeconomic shocks hit all at once. Oil prices quadrupled. Inflation surged from 3% to over 11%. Unemployment doubled. This toxic mix triggered the worst bear market since the Great Depression, with the whole market plunging 50%. And when the economy falls apart like that, overpriced stocks don't just correct, they get absolutely obliterated. The so-called bulletproof stocks were anything but. Coca-Cola shares fell over 60%, McDonald's fell over 70%, and Polaroid, oh man, its shares collapsed by more than 90%. The one-decision stocks became one big financial obituary. And crucially, this damage wasn't just some quick dip. There was no V-shaped recovery here. It took the market 8 full years, all the way until 1981, to finally crawl back to its pre-crash levels. Investors were just trapped in financial purgatory for nearly a decade.
Now, if this story is giving you a little sense of déjà vu, you're not alone. Let's fast forward to the present day and see how this all kind of builds into a modern parallel.
As Mark Twain famously said, history does not repeat itself, but it does rhyme. And while today's market isn't a carbon copy of 1972, you can't deny it definitely rhymes.
Remember how the Nifty 50 made up 45% of the market? Well, take a look at today. The tech giants we all know as the Magnificent Seven, Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia, they now make up around 36% of the entire S&P 500. Just 7 companies are carrying the weight of the market. Sound familiar?
And what about their valuations? Okay, they might not be as extreme across the board, but they are certainly priced like gravity doesn't affect them either. We're seeing PE ratios of 38 for Microsoft, 50 for Nvidia, and a really staggering 247 for Tesla. Now, are these amazing companies? Absolutely. But are they also being worshipped as if they're completely bulletproof? It sure seems that way.
This all leads us to the big question, right? Here we are again, staring at a super top-heavy market, pretending that valuations don't really matter for the best of the best companies. Are we just making the same exact mistake all over again?
You know, Warren Buffett really summed it up perfectly. The ultimate irony here is that the biggest lesson history teaches us is that we are really, really good at ignoring it.
And that leaves us right back where we started, whispering those four most expensive words in the English language. This time, it's different. Or is it?